The world moves on water. Every product you own, your clothes, your phone, the coffee you drink likely traveled thousands of miles across oceans before reaching you. Shipping is the backbone of global trade, responsible for carrying over 80% of all merchandise worldwide. But behind the colossal ships, towering cranes, and bustling ports lies a less visible force that makes it all possible: finance. The global shipping industry isn't just about moving goods. It's about loans, investments, credit, and complex financial networks that dictate the speed, efficiency, and survival of maritime commerce. Without finance, even the mightiest cargo fleet cannot function. Today, we explore the revolutionary role of finance in shaping the maritime economy, how it fuels growth, innovation, and even crisis, and why the shipping world is as much about money as it is about movement. Shipping, the lifeblood of global trade. At its core, shipping is simple: move goods from point A to point B. But the scale of global trade makes it extraordinary. A single container ship can carry thousands of containers, each worth millions of dollars. Ports operate 24/7, and schedules are dictated by supply chain demands across continents. However, building and operating a ship is expensive. Modern cargo vessels cost hundreds of millions of dollars. Fuel, maintenance, crew salaries, port fees, insurance, and technology investments all add up. For many shipping companies, financing isn't optional. It's the difference between survival and bankruptcy. The maritime economy is intertwined with financial markets. Shipowners borrow heavily, investors provide capital for fleets, and banks structure loans with complex terms to manage risk. Every cargo movement, every expansion, and every new route relies on financial strategy as much as operational expertise. Shipping connects economies, but finance powers the connection. The role of ship financing. Shipbuilding is capital intensive. Few companies can afford to pay the full cost upfront. This is where ship financing comes in. Banks, investment funds, and private lenders provide loans or credit lines to fund ship construction, purchase, and operation. These loans are not small. Financing a modern container ship or tanker can involve hundreds of millions of dollars. Lenders assess risks such as the volatility of freight rates, fuel costs and fluctuations, global economic trends, political stability of trading regions. Banks don't just provide cash, they structure contracts to protect themselves. Mortgages on ships are common, allowing lenders to repossess vessels if borrowers default. Insurance is layered on top, protecting against accidents, piracy, and natural disasters. Ship financing is a careful balance. Lenders want high returns, but minimal risk. Shipping companies want growth, efficiency, and fleet expansion, but each decision is tied to financial feasibility. Without access to capital, even a company with the best operational plan cannot expand or survive a downturn. Investment and ownership models. The financing revolution in shipping isn't limited to banks. Investors play a massive role. Shipping companies can raise money through public stock offerings, private equity, or specialized maritime funds. Ownership models vary. Single-owner fleets. A company owns and operates all vessels, controlling every aspect. Leased or chartered vessels. Companies lease ships, paying rent or charter fees, reducing upfront investment. Joint ventures. Investors and operators share ownership, spreading both risk and profit. These models are financially complex. Investors want predictable returns, but shipping revenue is tied to global demand and supply fluctuations. Freight rates can surge during economic growth or plummet during recessions. Fuel prices, geopolitical events, and trade wars all impact profitability. Finance allows shipping companies to absorb volatility. By structuring loans, leasing, and investment agreements carefully, companies can continue operations even when market conditions are unfavorable. Freight futures and financial instruments. One of the most sophisticated financial tools in the maritime economy is the freight futures market. These allow companies to hedge against fluctuations in shipping costs. Imagine a company that needs to transport goods from China to Europe in 6 months. Freight rates might rise sharply due to global demand. Through futures contracts, the company locks in rates today, reducing uncertainty. Similarly, shipping companies hedge fuel costs using derivatives. Modern vessels burn tons of fuel daily, and price spikes can wipe out profits. Hedging stabilizes expenses and ensures that financial plans can remain realistic. This fusion of finance and operations is what allows shipping to handle massive volumes efficiently. Without sophisticated financial instruments, companies would be exposed to unacceptable levels of risk, and global trade would slow dramatically. The shipbuilding boom and global finance. The past 2 decades have seen waves of shipbuilding booms, each fueled by financial optimism. In periods of strong economic growth, investors and banks pour capital into new fleets. Shipyards expand, orders increase, and companies rush to secure vessels for anticipated demand. But boom cycles carry risk. Oversupply of vessels can depress freight rates, turning previously profitable operations into losses. Companies heavily leveraged with debt may struggle if market conditions reverse suddenly. The 2008 financial crisis provides a clear example. Global trade collapsed almost overnight. Companies that had financed large fleets with debt faced bankruptcy. Ships were repossessed. Orders were canceled. Lenders lost billions. Finance doesn't just drive expansion, it determines the survivability of companies during downturns. The ability to secure flexible, smart financing can mean the difference between growth and collapse. Shipping, global trade, and credit. Shipping companies are integral to global trade, but trade itself is financed. Letters of credit, trade, finance, and banking guarantees allow importers and exporters to operate smoothly. Without financial instruments, moving goods internationally would be risky and inefficient. Suppliers might not ship products without guaranteed payment. Buyers may be reluctant to pay upfront. Credit bridges the gap, ensuring that cargo moves, invoices are honored, and profits are realized. This system is heavily reliant on trust, regulation, and complex agreements. Banks, insurers, and shipping companies must coordinate seamlessly. When financing fails or credit tightens, as seen in economic crises, entire supply chains can freeze. The 2020 pandemic is a recent example. Sudden disruptions in credit and logistics caused shipping costs to skyrocket and delays to multiply, demonstrating how deeply finance underpins the entire maritime ecosystem. Mergers, acquisitions, and global fleet expansion. Financial power drives consolidation in shipping. Large companies acquire competitors, merge operations, or purchase strategic ports and assets. These moves are rarely just operational, they are financial. Acquisitions allow companies to increase market share, control pricing, expand route networks, optimize economies of scale. But mergers often require billions in financing. Banks and investors must assess not just the operational benefits, but the financial risks of integrating massive fleets. A poorly structured acquisition can lead to debt overload, reduced flexibility, and, in some cases, bankruptcy. The shipping revolution isn't just about bigger vessels, it's about bigger financial structures underpinning global fleets. Risk management in a high-stakes industry. Shipping is inherently risky. Storms, piracy, mechanical failures, and geopolitical tensions all threaten operations. Financial risk management is essential. Insurance alone is a massive industry in maritime finance. Cargo insurance, hull insurance, liability insurance, each protects companies and investors from catastrophic losses. Reinsurance spreads risk further, allowing global insurers to manage exposure. Companies also hedge financial risks, including currency fluctuations, interest rate changes, and fuel price volatility. Modern maritime finance is as much about predicting uncertainty as it is about funding operations. Without these financial safeguards, even minor disruptions could have catastrophic ripple effects across global trade, technology, efficiency, and financial investment. Modern shipping is a high-tech industry. Advanced navigation systems, automated cargo handling, fuel-efficient engines, and digital supply chain management all require significant investment. Finance drives innovation. Companies invest billions in new technologies, not only to increase efficiency, but also to reduce operational costs. Investors fund environmentally friendly vessels, digital tracking systems, and next-generation port infrastructure. Financial planning ensures these investments are sustainable. Shipping companies weigh upfront costs against long-term savings, assessing ROI and risk. Without financial backing, technological progress would stall, and shipping efficiency would lag, affecting global trade and economic growth. The future: green shipping and financial transformation. Today, the shipping industry faces new challenges: climate regulations, decarbonization mandates, and environmental pressures. Transitioning to greener fuels, retrofitting ships, and investing in sustainable infrastructure requires massive financial resources. Banks and investors play a crucial role. Green bonds, climate funds, and sustainability-linked loans are emerging to finance eco-friendly shipping initiatives. Companies that fail to secure capital for the green transition risk falling behind, while those that successfully leverage finance can gain competitive advantage. The future of shipping is as much about financial innovation as technological innovation. The companies that thrive will be those that combine operational expertise with smart financial strategy. Finance is the true engine of global shipping. Shipping may move the world's goods, but finance moves shipping. Without loans, investments, credit, and sophisticated risk management, the global maritime economy could not exist. Finance allows companies to build massive fleets, innovate, weather crises, and expand trade across continents. The shipping revolution is ongoing. As trade volumes rise, technology evolves, and environmental challenges grow, the financial strategies supporting the industry become more critical than ever. Shipping is no longer just about steel and engines, it is about capital, credit, and complex financial ecosystems that enable the world to function. In short, finance is the invisible engine that drives the ships on the water. Without it, the entire maritime economy would grind to a halt, proving that the real power behind global trade isn't just logistics, it's money, strategy, and investment. And as the maritime industry faces its next revolution, whether through green technology, digital supply chains, or new global trade dynamics, finance will continue to shape the future of the world economy, quietly steering the vessels that carry civilization forward.